Good morning, afternoon, evening, and welcome to Concerned Citizens Presents, a new offering on Village TV. Concerned Citizens of Laguna Woods is an organization committed to peace, social justice, economic equality, and a clean environment. For the duration of the lockdown, instead of its usual 2 meetings a month, Concerned Citizens will broadcast 2 programs a month on this channel. Our programs will feature films, lectures, and debates on topics related to our mission. We hope you enjoy today's program.
Welcome to Concerned Citizens Presents. My name is Suzanne Modell. I am chair of the Concerned Citizens Program Committee, which is the committee responsible for planning these broadcasts. Today, August 12th, 2020, our committee is pleased to present Barbara Siry, a Laguna Woods resident and activist. She will speak to us about many troubling behaviors in America's financial sector. Drawing on 2 recent book reviews, one in the New York Review of Books, the other in the Atlantic, Ms. Siry will explain how misbehavior on the part of bankers and laxity on the part of regulators transformed America's housing market to the detriment of ordinary people. Today, with pandemic-induced unemployment leaving millions unable to meet their rent or mortgage payments, these insights could not be more timely. Barbara Siry was born and raised in Northern California. She holds a BA from Berkeley and an MA from Rollins College. She spent 30 years in Florida as a sales rep for publishers of college texts and has taught humanities as an adjunct instructor at Valencia College. With her husband Joe, she arrived in Laguna Woods in 2016. An avid traveler, Ms. Siry is a past president of Concerned Citizens and an active member of the Laguna Woods Democratic Club. Welcome, Barbara Siry.
Thank you, Sue. And let's go ahead and share the screen so hopefully everyone can see my PowerPoint. And I will put it on. Can you see that okay?
Yes, we can.
Wonderful. And thank you, Sue, very much for inviting me to do this review for Concerned Citizens. As you said, my themes for this presentation cover banking misbehavior and the government response to this misbehavior. And as you said also, I'm going to review 2 articles. The first is a review of a book done for the June issue of the New York Review of Books by Francesca Mari. The book in question is Homewreckers: How a Gang of Wall Street Kingpins, Hedge Fund Magnates, Crooked Banks, and Vulture Capitalists suckered millions out of their homes and demolished the American Dream. That by Aaron Glantz. The second piece is entitled The Looming Bank Collapse. The U.S. banking system could be on the cusp of calamity. This time we might not be able to save it. This article by Frank Partnoy appeared in the July-August edition of The Atlantic. So as you can see, I've chosen 2 very cheery topics, but they're both old and new, familiar and surprising, banking misbehavior and its consequences for the American public, and the government response, or whether or not our financial system learned from its previous 2008 mistakes. So hold on to your mutual funds. This could be a bumpy and expensive ride. So let's go back to 2008. Where the author, Aaron Glantz, with his long and colorful detailed book title, tells the story of what happened and, more importantly, what should have happened during that fateful period when the country's economy collapsed. You should see some familiar faces on that cover. So to begin, in February of '08, as housing prices began to fall, but no big bankruptcies had yet been announced, Senator Chris Dodd and former Fed Chair Alan Blinder realized this decline could portend a very bad outcome. And so they went before Congress and argued for a revival of FDR's Homeowners Loan Corporation in order to help those mortgage holders in jeopardy of losing their property. The money they asked for amounted to between $200 and $400 billion. They hoped this sum would help staunch the losses among homeowners who were in way over their heads and whose homes had lost significant value. Well, according to Blinder, they got nowhere before Congress and were even laughed at for asking such a large amount to help homeowners. But the situation quickly changed. Bear Stearns collapsed in March, and things were going downhill fast. So Congress shortly thereafter approved $700 billion to bail out the banks, with no money then left over for homeowners. These big investment firms, considered too big to fail, were deemed essential to the US economy, not the individual homeowner who took on too much debt. It was the homeowner who was shamed. And this cartoon pretty much tells the story of the hypocrisy of much of the prevailing opinion by pundits, financial experts, and by default by Congress. But if I can go back for a moment and cover some familiar ground as to the origins of this crisis, I'm sure as many of you know, banks had invested too heavily in the prime and subprime mortgage market, particularly with the product known as a collateralized debt obligation, or CDO. So what are these? To put it simply, which is okay because even most bank executives need these definitions simplified, they're categories of various sorts of loans banks make. This slide illustrates the process pretty clearly. We start with the retail bank, essentially our neighborhood bank that makes loans to individuals and small businesses. But our retail bank doesn't keep these loans. It instead sells them to a big investment bank. And that investment bank, in turn, repackages the loans into securities labeled CDOs, organizes them into complex tranches, which is simply a fancy French word for portion or slice. And they're based on their risk level, with AAA ratings as the safest or lowest risk, all the way down to equity or highest risk level. Then the investment bank sells separate categories of tranches to individual clients, such as pension fund managers and insurance companies. And it's important to keep in mind who the investment banks are selling these tranches to. So all of this seems straightforward enough, but I did a little research into it. And to get a really in-depth look, take a look at this slide. This is how they actually work, and it's utterly mind-boggling, and especially for investigators who are trying to figure out what happened in these holdings after the collapse. But we really don't have to worry about these details, just the fact that most of the repackaged CDOs were home mortgages, especially subprime mortgages. And this subprime market was essentially created by the banking industry to fatten their profits. With housing prices on the rise, they felt they couldn't lose. Aggressive tactics such as lowering or eliminating the threshold to purchasing homes, like no money down, interest-only loans, adjustable rate mortgages, and balloon payments all were used as lures, targeting buyers with low credit ratings and little means to make the payments. But everyone was happy. Loads of money was being made. Everyone was awash in credit, and homeowners were enjoying their big new expensive homes. No one cared or felt the need to pose the question to buyers, can you afford it? Because it was a truth universally acknowledged that housing prices will never decline, or some such thing that Jane Austen said back in 1802. But despite that comforting assumption, you would have thought these predatory housing loans should have raised alarms by the feds and welcomed the efforts made by Blinder and Dodd, but they didn't. Because in a complicated way, CDOs are supposed to protect banks from taking on too much risk. Because as I mentioned earlier, CDOs were sold to other buyers and did not stay on the bank's own books. Hence, the Fed chair at the time, Ben Bernanke, didn't react. But that's not what was happening. Banks were retaining an interest in these CDOs in order to collect interest and principal payments. In short, banks were deeply exposed. When the party ended in 2008, the housing bubble, way over its rational price levels, burst. And with it went the mortgage CDOs. The feds tried reassuring everyone that it was just housing, that was in trouble. But remember, those CDOs were held by pension and mutual funds and large brokerage and insurance companies. In short, a big chunk of the economy. So after much heated debate, the Fed and Treasury stepped in and bought up many of those CDOs with that $700 billion bailout I mentioned earlier. And the economy began to stabilize. But there were winners and losers in this distribution. Individual homeowners were collateral damage and got little to no help, nor did a multitude of distressed firms deemed too small. But enter the vulture capitalist, the real winner in this swamp, a species of wealthy individuals ready to pick the financial carcasses of the vulnerable. One such group of vulture capitalist billionaires see an opportunity to buy a floundering FDIC-insured IndyMac bank in California. It was carrying an enormous number of CDOs and now was near bankruptcy. This group of billionaires included George Soros, J.D. Flowers, Michael Dell, and my favorite, that handsome guy, Steve Mnuchin, who, by the way, was the only non-billionaire in the group. FDIC employees, burdened with the housing collapse all around them, did not want to have to manage floundering banks themselves, and were only too happy to hand them over to just such an investment group. But risk takers, these buyers were not, which is really the whole point of Glantz's book. The government made sure there was little to no risk in taking these mortgage-indebted banks off their hands. So for only $1.6 billion, the group took control of all of the assets of the bank in question. This included all its branches, real estate deposits, and loans, all valued at more than $20 billion. But here was the real edge. A generous loss share agreement the government offered these buyers. It applied to all bad mortgages the buyers were now assuming with the failing bank and goes something like this. If, for instance, a homeowner owed $300,000 on an FHA-insured mortgage, but the home only sold at foreclosure for $100,000, the government agreed to reimburse the rest, all $200,000. So the billionaires couldn't lose. The majority of auctioned homes were, of course, bought when they were way overpriced and would never have sold at their original level. But the billionaires didn't mind because Uncle Sam made up the difference. This kind of guaranteed profit went a long way in discouraging investors from working with homeowners to keep them in their homes, like helping to renegotiate a loan at a more realistic price. It was much more profitable to foreclose on it, which they did on more than 77,000 homes. And the bank in question? It is now called One West. We have one right over on Paseo de Valencia by the CVS pharmacy. And of course, Steve Mnuchin is a proud owner. However, there was a catch inserted into this government sweetheart deal. If the bank's original owners had been bad actors, and by that I mean if they broke the rules in issuing their foreclosure notices, the loss share giveaway would end. However, according to the California Attorney General's office, the bank had multiple violations. They backdated false documents, foreclosed without legal authority, and failed to properly notify homeowners about foreclosure. Kamala Harris was Attorney General at the time and did nothing to stop this, according to Glantz. Even though of those 77,000 lost homes, tens of thousands were fellow Californians. And I still hope she's going to be our vice president, but we need to know everything. Anyway, back to my paper. The injuries to foreclosed homeowners does not end here, but only gets deeper and more ingrained. With One West now firmly established, its new owners proceeded to model what would become widespread practice. Instead of being the community bank, as their PR suggests, it shows how caring they are in this slide. They were really nothing of the sort. With the vast profits their purchase and retrofitting of One West provided the bank, they proceeded to deny loans to local businesses and homeowners, rather preferring to lend huge amounts to wealthy investors such as Thomas Barak, leaving the bank's neighbors to go elsewhere for financial help. And if you notice on this map, many of One West's locations are in underserved neighborhoods. Now, Thomas Barak, he's a character that Aaron Glantz is really fascinated with. He's an interesting guy. Glantz cites him as a private equity titan, a Trump mega donor, and hence that's all the connections between Trump and Barak. And he's also the founder of Colony Capital. As an aside, Colony Capital, Barak actually created it during the savings and loan crisis, exploiting the $4.8 billion in government subsidies to cash in selling bad loans back to investors. So he's a real bad actor too. In addition, according to an August 2019 article by Politico, Barak also allegedly pushed the Trump administration to give Saudi Arabia access to sensitive nuclear technology while at the same time trying to profit from the potential deal. This according to the House committee. And the LA Times recently reported that Barak assisted the Qatari Prince Sheikh Khalifa in getting this somewhat unqualified student into USC by negotiating an interview with the president of USC and, of course, promising large donations to the university. But I digress, because the real reason Glantz focuses on Barak is what he does with the money that he borrows from One West. In 2012, he begins buying steeply discounted foreclosed homes in the Los Angeles area, 3,000 at last count, and keeps them as rentals. Other large investment companies soon followed suit, primarily snapping up homes in the Sunbelt area, with Blackstone eventually emerging as the largest collector, with an assemblage of over 80,000 homes. As Glantz and our reviewer Mari point out, no longer were these suburban homes a way for the middle class to accrue savings by purchasing 30-year mortgages. Now they were simply lucrative investments for the very rich. What Glantz really wants his readers to think about with this enormous government giveaway is not just the bailout money to stabilizing the banking system, but the neglect of individual homeowners that followed, particularly as the government went about unloading its own burden of defaulted mortgages into the claws of the hovering vulture capitalists. But many in Congress, in fact, thought selling these mortgages at bargain basement prices was a really good idea and would even go a long way in stimulating the moribund housing market and lowering rental prices. Obama's Treasury Secretary at the time, Timothy Geithner, agreed and helped the process along through HUD auctions. But did it really lower rents? According to Glantz, the optimism proved to be sorely unfounded. Monthly rental prices soared, and entry into the mortgage market was steeper and higher than ever. But the real rot of the program lay in its very core, in unloading its enormous debt from foreclosed homes. The federal government chose speed over fairness with little to no consideration of the original individual owner. There was no requirement to force investors to work with the owner. No principal reduction, even though the houses in question had lost half their value. The owner didn't even get priority in bidding on his or her own home when it went up for auction. And not surprisingly, 95% of these mortgages were eventually bought by private equity firms within just a few years. In short, Glantz says, this is how the 1% has managed to monopolize credit. But how did Barak's Colony Capital fare in this program? Well, it acquired one of the biggest bundles at 970 houses through the HUD auction alone. Much of it financed by its revolving door credit with One West, because some folks will always have access to credit. Glantz charges that the Obama administration could have acted more generously with homeowners and lists a number of options it should have taken, like wiping clean damaged credit scores of victims of those predatory mortgage products, and at the very least, allowing homeowners to repurchase their homes through the Homeowners Loan Corporation. Nearly 10 million Americans lost their homes between 2006 to 2014. The anemic government efforts that were put forth to staunch this flow of auctioned homes and keep residents in their property involved overly complicated application and approval processes, and that ultimately declined 70% of applicants. It should then come as no surprise that today, renters now outnumber homeowners in nearly half of all major cities. That statistic, combined with wage stagnation, has left homeownership at its lowest rate since the 1960s. What's worse, renters who are unlucky enough to contract with one of these private equity firms often gets the short end of the stick, and they're responsible for everything: their own yard work, their own maintenance, or they get no maintenance at all with their homes. One thing they do get, however, are regular rent increases, sometimes doubling over the course of a few years. One such horror story the reviewer Mari references describes how a couple in one of these rentals had a mold and roof leakage problem, which their leasing company refused to fix. Water was literally pouring from the ceiling into a bucket in the living room. The husband eventually developed a lethal lung disease from the mold, and the couple had to vacate with no compensation for their trouble and expense. When renters threaten to sue, the agent they contact is often dismissive, declaring that the company's in court all the time and always wins over renters. In short, the rental is just there to secure as much profit as possible for these companies and is often not considered a long-term investment to look after. In fact, rentals make life much easier for the corporate owner in that it's so much faster to evict a renter than it is to sell the home and then have to repossess it if the owner can't meet the mortgage. Getting an owner out can take over a year. A renter, just a few weeks. Finally, Glantz makes an interesting comparison between present-day vulture capitalists and vulture capitalists during the Great Depression. If government puts the right incentives in place, he argues, vulture capitalists will do the right thing. A case in point, Donald Trump's father, Fred. Trump Sr. took advantage of a loosening of credit under the FDR administration if he agreed to build high-quality homes for middle-class Americans, and he did so. When FDR switched to apartments, Fred proceeded to build high-quality apartments. The lesson? If you fund and oversee it, even the most rapacious capitalist will provide a good product. The clincher is in close oversight with the public's interest at the core. So it's evident that real reform was not implemented as a result of the 2008 crisis, despite Congress's attempts at legislation to right the wrongs done. The government balked and did little to ensure that the enormous bailout the American people paid for went to individual homeowners. And today, taxpayers have every right to ask, are our banks behaving more responsibly now? Well, according to Frank Partnoy, in his article appearing in July's Atlantic, not so much. In fact, he worries that this time around, if the banks act irresponsibly, the governments will not be able to bail them out. This, Partnoy claims, is the worst case. But it's not homeowners this time at the center of the rot. It's businesses that banks are now targeting with risky loans. Our author, Frank Partnoy, a regular contributor to The Atlantic, is a law professor at UC Berkeley School of Law and a frequent publisher on topics covering business and finance. Partnoy, at the beginning of his article, posed a very unsettling question. What if you woke up one morning to find the financial sector had collapsed? Now, we might be inclined to think that this is impossible and an exaggeration. Look how generous the government was when the first collapse occurred as a result of the housing bubble. And after just a year or so, everything was rosy and the stock market went up, creating a long bullish run. Besides, you could argue, we now have the DoddFrank Act. This legislation guaranteed that banks be more conservative and more transparent in their investments, at least in theory. Everyone learned their lessons, right? Congress even went after those credit rating agencies that gave AAA ratings to some very sketchy loans, so everyone's hand was slapped. But as you can see from this slide, consumer groups working to implement Dodd-Frank face an uphill battle with Congress. There are just 20 consumer group lobbyists to 406 private finance lobbyists. And look at how many the Chamber of Commerce has there, 183. They all work diligently to weaken the legislation, and the lobbyists have been quite successful, especially with the current Trump administration, which has been a real foe of this legislation, and who in 2017 removed small banks from the legislation's oversight and freed them up to invest as they choose. It's not surprising then, as Partnoy points out, that banks quickly began slipping into their old bad habits. Let's go back to those CDOs for a moment, the instrument banks used to package home mortgages. Well, they were now in disfavor after the collapse, so banks began looking for another acronym and opportunity. This time, they soon came up with the idea for a new product called a CLO, or collateralized loan obligation. These, not surprisingly, work similarly to the CDOs, in that banks repackage and sell these bundles of loans as securities, but instead of home mortgages, they are now business loans. And many of them are, you might guess, very sketchy loans. They are made to businesses that are already in deep trouble, many of which have already maxed out their credit, are unable to sell bonds, or can't get a legitimate bank loan. They are on the edge, just short of bankruptcy. Getting a CLO can be the last-ditch attempt to salvage a business. So here's a diagram of how it works, just to quickly revisit this structure. Pretty much the same as the CDO, using the same kinds of loan category. Each tranche is measured by its safety to the investor. They are then sold separately to institutions. The top layer, those AAA tranches, are still the most secure, but can still lose money if all the other layers default over time. And there are now more than $1 trillion worth of these leveraged loans currently outstanding, according to Partnoy. It's unimaginable. It's actually 5% of the national debt, currently at about $21 trillion. And just as the CDO mortgage boom helped power the market expansion in the early 2000s, so the CLO boom is thought to be triggering the current market boom and is bigger than the previous subprime market. Of course, this is all at least in pre-virus terms. But these CLOs are greatly heralded by Mnuchin and Federal Reserve Chair Jerome Powell, arguing, just as earlier Fed Chair Alan Greenspan argued, that these leveraged collateralized loans keep the risk outside the banks. In other words, they're not directly owned by the banks because the banks package and sell them to other buyers, right? Shielding them in the event of a financial collapse. But that's what they said about CDOs, and we all learned later, much to our chagrin, that the banks were totally exposed to the mortgage collapse. Now, Partnoy is uniquely qualified to warn taxpayers about these CLOs because he worked at Morgan Stanley, actually doing some of the structuring of these loans during the 90s, when many of these exotic financial instruments were being developed. He now argues that the Fed has no idea how exposed banks are to these CLOs because banks are not required to produce a clear accounting of their holdings. In fact, upwards of 14% are completely unaccounted for. As a case in point, Professor Partnoy decided to try to find out how heavily his own local Wells Fargo bank was. It holds his mortgage. He wanted to know how many CLOs they have. As you recall, Wells Fargo was the bank that was discovered to have created all those fake bank accounts a few years ago. Now, this was not an easy job, and Partnoy found himself digging far into the bank's annual report before coming upon a cryptic report on page 144, announcing that there were some investments available for sale. Most of us would probably have just brushed over them, thinking they're pretty conventional and not become alarmed. There were assets such as U.S. Treasury bonds and municipal bonds, the kinds of assets you'd want your bank to hold. But then Partnoy came upon some CLOs layered among these safer items, and he quickly realized that these were worth almost $30 billion, a huge amount, and they were not held separately from the bank. No, these were held inside the bank itself, contrary to what Mnuchin and Powers asserted. I'm sorry, I don't mean to be flippant, but this gets so heavy. Sometimes I just have to put a joke in here and there. Partnoy, considering the current precarious financial situation due to the pandemic, figured that Wells Fargo, holding such a large number of CLOs, could be in serious trouble should a number of these default. The question then became, did Wells Fargo have enough capital on hand to contain a possible massive default? Interestingly, Partnoy never actually answers that question in his article, but he does go on to talk about some other banks. So it prompted him to research the status of capital on hand in several major banks and found that while many banks were well capitalized, 30 global systemically important banks had an average of 60% exposure to CLOs. One bank in particular in our own state, Bank of California, has CLOs totaling more than 100% of its capital, according to the Financial Stability Board, or FSB. This is a private international body that monitors and makes recommendations to financial institutions. And just like One West, we have this bank right in our own backyard. The FSB warns that no bank wants to be in a situation where their liabilities are greater than their assets. But what the FSB can do about it is not discussed and still leaves a question hanging. But fear not, because as I've mentioned earlier, many financial experts, including the Fed, still maintain that it's okay to load up on CLOs. And in what I consider a completely confusing turnaround, even if the banks decide to keep them on their own books, because after all, a bank would only own AAA rated categories. So on any given pile of tranches, you'd assume the bank would concentrate their purchases at the very top, as this illustration suggests. So there's a lot of kind of confusing ambivalence in these policies towards CLOs. But let me continue, because we have to remember those AAA tranches, what they consist of. Recall that Partnoy claims CLO loans are primarily made to businesses that were already on shaky ground and didn't qualify for conventional loans. Well, it's those very businesses that make up that top layer. Hence, buyers of these AAA loans are not necessarily getting pristine and reliable debt. That is, businesses who have their debt under control and can readily make their payments. Partnoy argues that CLO AAA tranches really should be rated as B-level investments, which is really apparently a very bad rating. Only those risk takers who can absorb big losses in hopes of big profits should go to B and C rated tranches. Those at the bottom, the so-called equity levels, are essentially junk bonds according to Partnoy and make up around 15% of CLOs. So no major pension funds or insurance companies should ever be investing in those lower tranches. And now we're worried about the AAA tranches. But then he goes on to say, but at least buyers know what they're getting at the bottom. It's the opaque real value of the AAA ratings, however, that pose the biggest problem, because it's these layers that investors such as pension fund managers and banks feel safe to purchase and keep on their books. But according to what this article asserts, this AAA rating is seriously misleading. The conclusion Partnoy makes from all of this couldn't be more troubling. He writes, while banks restrict their investments mostly to AAA rated layers, what they really own is exposure to tens of billions of dollars of high-risk debt. In those highly rated CLOs, you won't find a single loan rated AAA, AA, or even A, according to traditional analysis. So if banks are exposed, what about those other investors who are buying up CLOs like pension funds? I did a little more research and found an article in Forbes, June 2019, by Mara Rodriguez-Valadares. And it illustrates how widespread the purchase of CLOs is throughout the domestic and international financial system, with insurance companies, mutual funds, etc., all participating in this game. And you can see from this grid the large area that U.S. insurance companies in this chart occupy. One such insurance company, AIG, is carrying in excess of $9 billion of CLOs. Remember, taxpayers spent $85 billion in 2008 to bail them out. I don't want to have to do it again. You can also observe that Europe and Japan are also heavily invested. In short, these entities, should they default, would jeopardize the very foundation of the US and global economies. But returning to Partnoy's assessment, having given us the optics of those AAA tranches which look to be precarious, unstable, and even worthless to buyers, it begs the question as to why those supposedly smart pension fund managers and insurance company analysts would invest their precious capital in the first place. One reason they apparently do so, Partnoy explains, is because the AAA tranches are heavily diversified. And like all diversified stocks, they're hedged against one big disruptive economic event. Now, while that sounds reassuring, Fitch's rating agency found several banks heavily leveraged in businesses hit hard by this pandemic-induced recession, industries that would normally be considered unrelated to one another and therefore diversified. AMC, for example, and Men's Warehouse. AMC is nearly $2 billion in debt spread across 224 CLOs. Men's Warehouse just declared bankruptcy. And Party City, another casualty in the social distance environment, is carrying $719 million in debt spread across 183 CLOs. These companies may never come back to their pre-pandemic levels and are prime targets for major defaults, according to Partnoy. And they were in trouble prior to this crisis, hence their pursuit of CLOs in the first place. It's no surprise then, when the prices of AAA rated CLOs began losing value in March, and the Paycheck Protection Program was supposed to include these risky CLOs in its $2.3 trillion emergency fund, but that didn't happen. Primarily because to many, this seemed extremely unfair, especially given that lots of small and responsible businesses were struggling and therefore more deserving. So far, none of the CLOs have gotten these government monies. So with no emergency funds coming their way, you'd think banks would pause in their pursuit of risky investments, and some apparently are. However, Partnoy writes, several are not, including Citibank and Bank of America, who are taking advantage of the current low prices and gobbling up AAA CLOs with the intention of flipping them when prices increase. Citigroup reportedly realized a $100 million profit doing just this. But loan defaults are nevertheless increasing, and April saw more than ever. Even emblematic strongholds such as J.Crew, Neiman Marcus, Pier 1, JCPenney, all filed for bankruptcy alone in this year. In May alone of this year, excuse me. And of course, we also just heard that Lord & Taylor declared bankruptcy in August. Partnoy predicts this will get much worse as time goes on. But just when you thought it couldn't get any worse than CLOs, bankruptcies, and opaque AAA tranches, Partnoy shifts his focus to another high-risk strategy that banks have begun utilizing to increase profits. They are called variable interest rate entities, or VIEs, just when you didn't need another acronym, and I apologize for that. These products consist of companies established by the banks to hold off-the-book positions. For instance, banks would own securities backed by commercial mortgages like shopping malls and office parks, but they don't show up on the bank's balance sheets. It's an accounting maneuver used to artificially inflate profits and make firms look more financially secure than they actually are. But investors and bank auditors have very little access to details about these assets. If you remember, VIEs are what Enron exploited in the late 90s with their many subsidiaries. Two of their more famous or infamous ones were named after Star Wars characters, Chuko and I forget the other one, a Jedi. Because their accounting and balance sheets were not required to be more straightforward, Enron could misrepresent profits and hide large amounts of debt in these holdings. So popular were these VIEs and touted as so safe that even CalPERS, that's California's massive pension fund for public employees, was a partner for a period of time. While not going into detail, which I can't pretend to follow, this slide gives you a sense of the convoluted relationships between Enron and its various subsidiaries that left many investors falsely secure in becoming partners. While Enron was eventually exposed, Partnoy points out that many US banks, Wells Fargo being one, currently have more than $1 trillion in these kinds of VIE assets. Partnoy complained that any further investigation into this troubling amount of risky holding was stymied because, as I mentioned earlier, full disclosures by the banks are not forthcoming and are pretty much impenetrable when they are. Partnoy ends his article with a prediction of possible outcomes. Excuse me, I hope you couldn't see that. To this recent spurt of hazardous banking behavior. He reassures his readers that we are not in the same situation we experienced leading up to the 2008 crash. Banks are not gambling with speculative derivatives or credit default swaps like they did back then, thanks to Dodd-Frank. Just as a quick aside, those VIEs in some of the articles I read are referred to as credit default swaps, meaning the bank is defaulting or swapping debt and profit off their books. But anyway, that's all I could get out of it. So it makes me feel that the banks are being a lot riskier than we would assume besides Dodd-Frank. And apparently, going back to why we should be encouraged, banks now have more capital on hand, also required by Dodd-Frank as a hedge against massive defaults. But, Partnoy warns, the coming downturn from these CLOs and predictable losses from VIEs will lead to serious shortages of capital, and some banks will have to sell their assets at fire sale prices. A few major banks may even see catastrophic downturns, much in the vein of Lehman Brothers and Citigroup in 2008. If this happens, Partnoy goes on, overnight lending between banks will stop, delivering a death blow to the economy. And then we get to the heart of what his primary thesis is. Will the Feds do a second bailout of Wall Street? That'd be twice in 1 century. There's little appetite for such a rescue in both parties, and our author doesn't speculate further. But he does say that should the government fail to step in, we could see a collapse in the availability of credit. That means loans for houses, cars, educations, etc. Credit could become unavailable to the American population and would have devastating ripples across the globe. That's why he remembers Henry Paulson got down on bended knee to beg Nancy Pelosi in 2008 to approve the bailout. This slide is rather dark, but you can see Paulson in the front kneeling before Nancy. Now, whether Nancy, this was her joke in response to that, but she did authorize the bailout. Whether she'll do it a second time if Jerome Powell similarly gets down on bended knee seems less likely. Partnoy leaves his readers somewhat hanging at the close of his exposition, with the hope that we'll avert this disaster, but gives no guarantees. He does provide a series of common sense reforms, but whether we are too late for implementation remains murky. Or even if banks would implement reforms, since many seem to be having a field day with their CLOs and VIEs. Like we heard back in 2008, banks need to go back to doing what they've always done. Make loans close to home and avoid complex new products altogether. And of course, require far more transparency. No bank, he argues, should ever be able to keep huge amounts of money off its books, nor should it owe more in liabilities than it has in capital to cover. Partnoy gives us 1 year, either to make these reforms or face the financial abyss. An abyss most of us have no real concept of what that entails. And in finish, just think what Frank Capra said all those years ago when Jimmy Stewart explained to his frantic customers how a savings and loan actually works. Its purpose is to serve the whole town with everyone's money invested in their neighbors' homes and businesses, not just with a few greedy bank executives like Henry F. Potter. So thank you very much for your time. And I look forward to talking to Sue for a second at the end of this. Hello, Sue.
Well, thank you, Barbara. You really worked hard how did you find all these wonderful slides?
That's the most fun. What the most difficult part is trying to make sense of the often confusing and complicated policies that the government has towards banks, and where the rating agency is in all of this. If indeed these CLOs are as risky as Partnoy is claiming they are, where are the rating agencies to warn us? So I felt there was a lot that was left unanswered, and perhaps in fairness to Partnoy, he can't really say whether Congress is going to bail us out a second time, or is even going to take the steps to prevent the economy from going to the edge. I mean, with our current administration, there's this, mythology that everything will be fine by October and November. But this is not what I've just read about with Frank Partnoy. It sounds pretty dire, and it sounds like the steps to reform what is going on right now are so straightforward that instead of reinventing the whole issue and the whole wheel, what Congress could simply do is take Dodd-Frank again and strengthen Dodd-Frank and make sure that all the players have to conform to a new and strengthened Dodd-Frank legislation.
Well, if we could just pursue that a teeny bit, I think it's important to remember that Dodd-Frank was crafted in the Obama administration. It was not something as a result of the Trump administration. So given that background, what is your sense, or the sense of the author, as to the likelihood that Congress would act to strengthen a bill that was essentially structured in a way, Dodd-Frank, as to allow all kinds of businesses, as you showed beautifully with the lobbying slide, thousands of lobbyists to come down and construct all kinds of exceptions and delays. So why would we think that might change?
Well, only because we have a Democratic House, not because of a Senate. And Partnoy doesn't go into those gritty details, which I really kind of needed. The reforms that he mentioned at the end are kind of cookbook reforms without a lot of concrete steps, and without a picture of Dodd-Frank with closing all those loopholes that the original Dodd-Frank has. But the House, I'm sure, would deal with this. It's the Senate that probably would not. So we're kind of stuck, and hopefully can hang on until the next election if we see a change in administration. If we do not, then anything could happen. and it doesn't look good at all. Waking up to find the financial system had collapsed, that was probably one of the scariest things I'd ever read. So I was a little frustrated with his lack of specificity. He wanted to, I think he felt his purpose was to clarify the problem and to let us know about all these acronyms. Go ahead, Sue.
Okay, well, I think we could go on chatting about this, but the fact of the matter is that we're out of time.
We're out of time. Thank you again. I really appreciate it. It was very interesting doing this research.
Well, we want, Concerned Citizens wants to thank you, Barbara Siry, for preparing this fantastically illustrated presentation, and raising our consciousness about yet another dysfunctional set of American institutions. And we thank you, our audience, for watching this broadcast. As long as the lockdown persists, Concerned Citizens Presents will be recording programs for your in-house enjoyment. Please join us for another episode soon.